listeners, I'm here to share with you about my stock account today. Today I've earned 1,160 US dollars. US stocks closed higher on Monday as the market focused on the progress of debt ceiling talks. Fed officials Gooseby the impact of rapid rate hike is largely unseen. In my account today, right now the net asset of my account is $33,120.27. Today's PL is a gain of $1,000 including the post-market price, which is a gain of 1.39%. In total, my account has earned $843,000.6. Today, United Natural Gas rose for 4.52% to $6.94. In its post-market, it dropped for 0.72% to 6.89. Dow Jones Industrial Average rose for 0.14%, Nasdaq Composite rose for 0.66%, and S&P 500 rose for 0.3%. The markets generally closed higher. Semiconductors led the way, with a gain of 2.33%. The banking industry and the tech industries showed a gain of 1.75%. On the other hand, utilities and auto and consumer electronics dropped for less than 1%. Investors are watching the progress of the bipartisan talks over the federal government's debt ceiling. The U.S. New York Manufacturing Index was far lower than expected. Microsoft's $69 billion deal for Activision Blizzard was approved by the European Union. Microsoft closed slightly up 0.16% after the European Union approved the $69 billion acquisition of Activision Blizzard, but the Competition and Markets Authority said it'll insist on blocking Microsoft's decision to buy Activision Blizzard. The U.S. debt ceiling standoff remains the focus. Analysts say that if U.S. politicians fail to reach an agreement on raising U.S. government borrowing ceiling, markets would be volatile and the U.S. economy will suffer disaster. John Stolfkutz, chief investment strategist at Oppenheimer Asset Management, said, "We think the good news is that the efforts to resolve the debt ceiling seems to have increased in the past few days, amid growing concern about market participants. Fears of recession and a lack of progress in the debt ceiling crisis weighed on stocks last week. Last week, the S&P 500 and the Dow fell 0.3% and 1.1% respectively, both marking their second straight week of losses. The Dow also recorded its fifth consecutive session of decline." Over the weekend, Treasury Secretary Janet Yellen suggested the country would avoid default. In an interview, Ms. Yellen said, "I am hopeful. I think the negotiations are very active. I was told that they have found some areas of consensus. My understanding of the postponement of the meeting is that the negotiations are making some progress. So the two sides want to have something practical to talk about when they meet again, which is good news to me. There were $88 billion left in the balance of special measures used to pay government bills as of May 11th, up from $110 billion, according to a Treasury document disclosed on Friday a week ago. Ms. Yellen said last week that a failure to reach a deal on the debt ceiling could create financial disruption, and that Treasury now uses June 1st as a date for a possible default. U.S. President Joe Biden is expected to hold debt ceiling talks with members in Congress on Tuesday. They were scheduled to meet on Friday, but the meeting was postponed as discussions at the staff level continued throughout the weekend. Mr. James Rossiter, head of global macro strategy at TD Securities in London, said, "Debt ceiling is a significant risk that everyone can see, but traders remain hopeful that the common sense will win." Rossiter said neither side wanted to default and he believed in agreement, but also said anything was possible. Wilson, a prominent Wall Street short and a strategist at Morgan Stanley, expects a debate over raising U.S. government's $31.4 trillion ceiling to spark some wild volatility in the stock market. Most customers believe that this will eventually be resolved, but that there will be some volatility in the short term. Wilson wrote in a note. Wilson added that many consider the debt ceiling impasse loss for the market. Even if the debt ceiling is raised before the so-called X day, the day Treasury runs out of cash. Given the sensitivity of the index to recent liquidity changes, it could squeeze liquidity to drive the S&P 500 lower, the strategist said. U.S. University of Michigan's preliminary consumer confidence reading on this Friday showed that the U.S. confidence fell to its lowest level in 6 months in May, amid a deadlock in debt ceiling talks and persistently high inflationary pressures. On Monday's economic data, the New York Fed Manufacturing Index for May was negative 31.8, negative 2.5 expected, and 10.8 lost. A number of Fed officials will speak this week, including Colin Powell on Friday. Atlanta Fed President Robert Bostic said on Monday that he preferred not to raise the interest rate at the June FOMC meeting. Traders now see the chances of the Fed leaving its interest rate unchanged at 17.7%, up from 8.5% a week ago. Friday, a report on Friday shows that long-term U.S. inflation expectations jumped to their highest level since up to 2011. Boosting the dollar and Treasury yields. Still, after the CPI and PPI data supported to 25 basis points before the end of the year, to stop raising rates in phases as inflation showed. President of Chicago Federal Reserve Bank, Austin Goolsbee, said a large part of the impact of the Fed's rapid rate hike is still spreading in the economy, and the policymakers need to be cautious in assessing the next move. Much of the impact of our 500 basis point rate hike in the past year has yet to come, Goolsbee said in an interview on Monday. He said it was too early to tell what Fed officials should do at their June 13 to 14 meeting. However, he said that his last vote for a rate hike was a difficult decision given the banking turmoil. At their meeting earlier this month, Fed policymakers raised interest rates by 25 basis points, bringing the benchmark rate to a target range of 5% to 5.25%, suggesting they will be ready to suspend the tightening cycle. He said the Fed is now focused on the extent which the financial pressure permeates other areas of the economy. At the same time, inflation is improving but not very soon, and the labor market remains strong, suggesting policymakers may have more to do to curbing price pressures, he said. The Consumer Price Index released last Wednesday shows the CPI rose 4.9% in April from a year earlier, the first time in 2 years. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.